Welcome to the Stock Market Palantir. Today we are going to talk about TAOP. We are focusing on Topping Incorporated, a microcap technology equity, which, despite being incorporated in the British Virgin Islands, does its operations primarily in China. This stock has been, well, defined by chaos over the last year, showing some extreme volatility, swinging from a 52-week low of $1.81 all the way up to $24.75.
And that staggering range is precisely why we need to talk about this. I mean, we're looking at a company that was historically a pretty quiet cloud services provider, which then just recently announced a really radical strategic pivot. They're trying to move into artificial intelligence, smart elevators, and the much hyped sector of embodied robotics. So the critical question here is whether this really dramatic price action plus the strategic shift signifies a genuine fundamental turnaround. Or is this volatility just, a cyclical thing born from deep-seated capital structure distress, just temporarily masked by some market microstructure anomalies?
My position is that this is a credible attempt at fundamental value creation. Yes, the risk is self-evident given their history, I get that. But the recent acquisitions and letters of intent, specifically Skyladder Group Limited and the LOI with Alpha Lion Holding, they represent a definitive break from a stagnant past. So I interpret the volatility as the necessary and, sometimes violent function of price discovery for a company that is completely redefining its business model.
See, I come at it from a fundamentally different angle. I view TAOP's recent moves less as a sincere pivot and more as a classic case of what we sometimes call capital market mining. I mean, they are consistently prioritizing raising capital through equity, no matter the dilution, over generating sustainable revenue. In my view, the underlying structural risks, the crushing history of dilution, the constant stress of just maintaining their NASDAQ listing, and the heavy institutional control you can see in the market mechanics, it all just overwhelms any exciting new AI narrative they're trying to sell. This isn't a turnaround. It's structural financial distress playing out in public.
Well, let's lay out the foundation for that turnaround thesis. The bullish case, it really hinges entirely on the successful execution and integration of these new strategic moves. And we aren't dealing with empty promises here. The acquisition of Skyladder, which, specializes in smart elevators, it provides TAOP with a concrete, quantifiable financial outlook. The terms of that deal tied directly to an aggressive revenue target of 74.14 million RMB projected for 2026. This move immediately connects TAOP to the hottest sectors: AI, robotics, and infrastructure tech. This provides a legitimate, evidence-based narrative for momentum, and investors are responding to that forward-looking potential. They're trying to shed the old low-growth cloud business and embrace something new. So if management can successfully integrate Skyladder and potentially Alpha Lion, the company has a clear path to growing well beyond its current market cap of just over $2 million.
That is certainly an ambitious projection, but I have to anchor this discussion back to the inescapable reality of the company's financial history. The primary risk factor is, and it has always been, the company's track record of just repeatedly mining the market and, frankly, ruthlessly destroying shareholder value. Like I said, the pivot is arguably a survival mechanism, required to meet the NASDAQ minimum bid price. We just can't ignore the history of reverse stock splits, which are mathematically devastating to long-term holders. They just did a 1-for-30 reverse split in May 2025. And when you stack that on top of the split since 2020, a 1-for-6, then a 1-for-10, you arrive at a cumulative reverse split ratio of 1-for-1,800.
Yeah, and to put that in perspective, if you held 1,800 shares just 5 years ago, you would now own a single share. That is a staggering loss. I won't deny how severe that number is.
Exactly. And that severity creates a structural anomaly we call a legacy selling overhang. This is the human consequence of that dilution. Anytime the stock gets a volatile price spike like the one we saw recently, you have all those long-term holders whose positions are just fractions of what they started with, selling those microscopic remnants to recoup pennies on the dollar and just get out. This selling pressure just puts a ceiling on any sustainable rally. no matter how exciting the new AI story sounds. And the company uses this process. They do reverse splits to create artificial scarcity, boost the share price, and then immediately issue massive amounts of new equity, like the 7.88 million shares for Skyladder. This dynamic fundamentally locks the stock into a recurring cycle of issuance and destruction, a structural death spiral.
Which leads us directly to our first key point of contention here: strategic acquisitions versus capital structure risk. While the dilution history is painful, we have to evaluate whether the potential long-term value of these assets justifies that necessary cost.
I'm sorry, but I just don't buy that the cost is justified, not when we look at the immediate financing reality. I mean, have you really considered how the company and NanoCap plans to fund the integration and heavy operation of these new assets? As of June 30th, 2025, their cash and cash equivalents were a mere $2.17 million, yet they just completed the Skyladder acquisition valued at about $21.36 million US, paid entirely in stock. How can a company with barely $2 million in cash fund the complex operations of a smart elevator business and then potentially acquire a robotics firm like Alpha Lion without just continued severe dilution that ensures the remaining float gets decimated?
I would frame the use of equity not as simple mining, but as a necessary strategic cost of growth. For a nanocap company trying to pivot into these high-value sectors, when you lack deep cash reserves, stock issuance becomes your currency for growth. The market, in those volatile moments, is pricing the future revenue potential. 74 million RMB by 2026 is significant for a company this size, not its limited current cash. Furthermore, that non-binding Alpha Lion letter of intent, while speculative, it explicitly ties the company to over 60 core patents in robotics and AI. That potential connection to embodied robotics is enough to justify a much higher speculative valuation than their legacy business ever could. You're focused on the cost, the market is focused on the potential return.
I'm just not convinced by that because the dilution is not a future cost. It is an immediate and crushing mathematical certainty. The post-May 2025 reverse split float was minuscule, approximately 0.89 million shares. The issuance of 7.88 million shares for Skyladder instantly diluted that existing float by nearly 800%. You cannot expect future revenue, which is highly dependent on perfect execution in a challenging Chinese market, to overcome that level of immediate quantifiable dilution. Any investor has to categorize this as speculative high risk, period.
Okay, so since you're emphasizing that the structural risk outweighs the future potential, let's pivot to how the market itself interprets that risk. That brings us to our second point: interpreting market microstructure and volatility. I still maintain that the extreme spike we saw on December 1st, where the stock surged to $4.25, represented genuine raw price discovery. We saw a dramatic, observable shift in market microstructure that day, specifically with dark pool trading.
Maybe explain that for the audience, because dark pool ratio is highly technical, but it is absolutely crucial here.
Absolutely. So, dark pools are private, off-exchange trading venues. Large institutional investors often use them to execute massive orders without showing their hand on the public market. When the dark pool ratio is high, it just means most trades are happening off-exchange. Okay, so days before that spike, on November 24th, the dark pool ratio was an extreme 76.34%, 3 out of every 4 shares. Then on December 1st, that ratio plummeted to a low of 11.29%. So when that buffer, that internalization engine was removed, the raw supply and demand of the tiny public float were exposed. This caused the stock to move violently upward, demonstrating real buy pressure reacting to the news.
See, that's one analysis, but I reframe that dark pool data completely. A 76% off-exchange short volume ratio doesn't just signify a buffer, it implies wholesale institutional internalization. Market makers are absorbing retail flow and actively preventing upward price pressure on the public exchange. The volatility on December 1st wasn't discovery. It was the chaotic unwinding of a heavily managed, artificially depressed position. The sudden drop in internalization just meant the manipulation mechanisms were lifted for a moment, exposing the artificial scarcity created by the 1-for-30 split to high-frequency trading noise and algorithmic momentum. This is HFT driving the price, not long-term fundamental accumulation. I mean, institutional ownership is what, 0.91%? It's minimal.
While I certainly agree that HFT and algorithmic trading dominate this space, their involvement doesn't negate the significance of the price action. The sudden drop in dark pool activity still proves the market was ready to price the news. Algorithms, just like retail traders, respond to catalysts. Their aggressive focus on keywords like AI, robotics, it validates the pivot narrative as a powerful trading catalyst. Even if the buying is algorithmic, the stock is being treated as a high-momentum play because of the strategic shift.
And that distinction between a trade and an investment leads us right to our final point, retail sentiment. I need to challenge this common assumption that TAOP is some kind of high-conviction meme stock. The data just doesn't support that at all. It's not a primary focus of major retail forums. Its short interest is only around 8.25%, which is, nowhere near what you need for a true short squeeze like GameStop's historic 140%.
Okay, I agree with your assessment there. It's not a main character meme stock, driven by organic social hype.
Exactly. Retail sentiment is, from what I can see, overwhelmingly cynical. They view it as a clear pump-and-dump tactic, not a deep value investment.
But, and this is crucial for understanding the price movement, that lack of deep organic conviction doesn't negate its trading profile. The price moves without a big social discussion precisely because algorithmic momentum traders are responding to the keywords, robotics, AI, and the sudden shifts in market structure. Because of the low float, the stock is a perfect candidate for volatility trading, supported by its high beta, which is currently above 1.49. Retail investors are aware of the pump tactics, but that awareness doesn't stop them from trading the volatility for short-term gains.
So we're basically agreeing that this is a trade dependent on market mechanics, not an investment based on sustainable fundamentals. And that's the whole problem. The narrative, however exciting, just can't overcome the structural reality of the balance sheet.
Well, the value is in the assets and the forward-looking narrative, even if the capital structure is compromised.
Which brings us to the summary. Look, while topping has engineered an aggressive, ambitious narrative built around these high-growth sectors, the structural risks, in my opinion, make long-term investment functionally non-existent. The combination of that 1 for 1,800 cumulative dilution, the perilous $2.17 million in cash, and the overwhelming institutional control you see in the dark pool, it means that TAOP is an archetype of the microcap pivot. It survives not through sustainable growth, but through a continuous detrimental cycle of equity issuance.
I fully acknowledge those deep structural risks, I do. However, the market, in those moments of extreme volatility, is clearly attempting to price two new major assets, Skyladder and the potential Alpha Lion deal, which offer a genuine, if highly speculative, path out of that historical death spiral. The volatility is extremely high, yes, but that volatility itself provides significant opportunity for traders who monitor that microstructure data closely, particularly the dark pool ratios. The shift in the business means that the historical chart, while terrible, may no longer be the sole determinant of future trading value. It's a high-stakes bet on execution.
It remains a warning label for the conflict between ambition and accountability in the capital markets.
Indeed. The story of TAOP really illustrates the intense conflict between strategic rebranding and the enduring realities of capital market mechanics in the microcap space. We've highlighted today the fundamental tension between the pivot versus the cycle, the devastating reality of that 1 for 1,800 cumulative dilution, and the powerful anomaly of the 76% dark pool ratio that dramatically dropped to 11% during a period of extreme price movement.
Yeah, it's a critical case study in how narratives intersect with liquidity and structural financial integrity.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks, don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.